So I think this is a good reminder on what is happening. We showed this chart previously on the growth, global growth optimism is at an all-time low, and the World Bank cut 2022 global GDP growth estimates to 3.2% from 4.1%. So again, we still think that 3.2% is too high, and that's something that's going to continue to come down. And in pure normal fashion, and it's unfortunate if you think about human life and what is happening with Russia, Ukraine, but that people get desensitized to things. And here's a perfect example when you look at recession fears, and that is now becoming a bigger consensus. So hawkish central banks, we've been saying from the beginning, and for those that have been following us, I've been called some very colorful, fun names. When we were talking about hawkish central banks, what does this mean? Global recession. But now, one of the things was inflation is going to continue to become a bigger issue, but the Russia-Ukraine focus, if you will, is deteriorating. And as that comes through, and it's not that people don't care, it's that the more the headlines come across, the more desensitized you get to it because you're expecting it. Like, oh, Putin did something bad. Well, we know that. Russia did something bad. We know that. The Ukrainians countered it. Okay, well, that's what was expected. So that it no longer becomes a market driver. And I think that's the key piece, which is why in the EIA show, we try to talk about what Russia's doing with oil, what the shifts are. But it also means that things are shifting a bit, and there's more of a focus on rates and bonds, especially when you start thinking about hawkish central banks. And then what does that mean for a recession as spending slows? So when you start looking at how that has reacted, the Bloomberg Global Aggregate Total Return Index, you can see is at a new all-time low. And then the Bloomberg U.S. Aggregate Total Return Index, U.S. Aggregate Index is also at an all-time low. So when you look at these drawdowns, does it mean anything? Right now the market is up 11 handles. The market essentially is telling you that I don't really care. It's softened a bit. It's only up 6 handles. So we did get the beige book coming out just now as we've been filming this, and you'll be surprised to know that inflation is a concern, that there's, and the market's already priced in, which will show a 50 basis point increase. And they're saying don't rule out 75 basis points. And that's becoming a concern as you're getting some of these drawdowns, as you're getting more pressure into the market on the bond side. What is that going to really do, and how is that going to interact with where equities are, especially when you start looking at Netflix earnings and earnings start to come out? And we already talked about how margin pressure was going to be there, and we were going to get a bit more some of these underlying issues. All the while, recent Chinese lockdowns have not yet been a factor in U.S. truckload freight slowdown, but it's coming. Containers out of China to the U.S. have dropped 31% since April 6th, which FreightWaves estimates is a 5% impact to U.S. trucking freight. Ocean containers out of China to U.S. have dropped by 31% since April 6th. So that drop off, and for those that watch the EIA show, this is what we were talking about. We're seeing these pressure points, and that's going to create more supply side inflationary pressures, more supply side problems. And those are some of the other continuing issues and impacts that we're already seeing. And the reason why this matters so much is because U.S. goods imports on an annual basis, when you look at China, China is a huge driver of where we get a significant amount of our goods. So as these continuous lockdowns, impacts continue, that's going to lead to more pressure points, which is why when we talk about inflation, when we talk about growth, when we talk about the economy, we really think that there is more of that downside pressure. And then when you look at specifically in the U.S., the outbound tenders, when you look at where things are in 2020, 2021, and you see the blue line. So 2020, 2021, you're at record highs. 2019 into 2020, you're at near record lows. The trend, which is that blue line where we are today, continues to fall off. And based on what we're seeing out of China, that's going to continue to come down, putting more pressure on some of that diesel demand and demand in general. And we don't see that essentially changing at this point in time. So now when we look at what is happening on the, let's call it the VIX level, the bond volatility level, This is just looking at 2020 to today. When you pull things back, the MOVE index is back to some of the highs that we saw during 2011 and 2014. But you can see that that bond volatility is going up as the equity volatility is kind of flat. And who's right, who's wrong? And when typically the MOVE index is kind of the leading indicator, and that's where we do expect to see more volatility, more downside pressure. But if you're looking to buy downside pressure, protection, it's fairly cheap right now when you start looking at the VIX index as we head into what we think is going to be a very interesting Fed meeting, which we think that there is a potential. So our view was that from last year was going to be 3 25 basis point hikes in a row. Now we're to a point where we think it's going to be 50, but 75 really isn't off the table based on what we're seeing and some of the fears in the market. And this is an underlying problem when you look at the historically low rates and where things are. So yield spikes often spell trouble for stocks, which again is some of the main concerns. But then when you start looking at what matters for stocks in the end, point of policy rates, even if the Fed goes as far as markets thinks, it's historically low versus past hiking cycles. So when you look at where U.S. inflation sits, and this is going back to 1992, and where the Fed funds rate is, and this is just looking at where the current is, where the 1 month ago was. So you're still seeing this creep up. Bonds are starting to price that in. Equities have so far ignored it. And I think when you start looking at the emerging markets, as we talked about in segment 1, that's where we continue to see a lot of these pressure points for the emerging market, as U.S. rates are really the price setter for these different pressure points. Now, some of the things that we've seen is the Taylor rule has been thrown around, and I think we've talked about it in the past. You can find this on the Atlanta Fed website. It's obviously, we think it's a great website and just a lot of functionality. So the Taylor rule was a paper that was written by I think it's John Taylor, but I won't bother looking now. But anyway, Dr. Taylor. And he goes through how, where should the Fed funds rate be based on GDP growth, based on inflation targets, based on current inflation, and you can use all these different spreads and you can see his formula, and you can actually, and that's why you alternate 1, 2, and 3, you can change some of those dynamics to see where we should be. No matter what number you put in, we should be at 7% or higher on a Fed funds rate. And we're currently at 0.5. So just, I shouldn't laugh but it's, I guess you have to, because if you didn't, you'd cry. This is why the Fed is so far behind, and why I wouldn't rule out a 75 basis point hike, because there has to be some of this, trying to get in front of it, because the equity market is essentially betting that the Fed's not going to do anything, that the Fed's going to yield. And even if they don't recognize it, equities are fighting the Fed right now. We're in a tightening cycle, where the world is in a tightening cycle, and the stock market continues to go up. So again, these are things that we have to consider as we go into that Fed funds meeting. Now, the 10-year real Treasury yields nearly positive using tips. But again, the difference is using tips and using spot CPI. So when you're using tips or Treasury inflation protected securities, you're positive. So 10-year tips yield are now up. But when you look at CPI, which continues to go up, which we continue to talk about, it is still way below where you're actually making money. You're actually losing money, because what you're going to get paid owning the 10-year, you're not going to be able to cover the inflation. So again, this is why we do think the 10-year yield is going to continue to go up. Now, another nail in the low-inflation coffin, which I always think is always a fun one, is when you start looking at the different shifts. So long-term inflation skew continues to move up, which is why when you start looking at the likely target of where the Fed funds is going to be, it still remains on that pressure point, moving towards 250 basis points, moving much closer to about 2.75%, which is confirmed here. So market pricing for the number of 25 basis point hikes Clearly that is a view that we're going to get over 25 basis points and something closer to 50 basis points. And then market pricing for the total Fed funds rate increases brings us to an exit rate of 2.5%. So the view is that by the time we exit 2020, the Fed funds rate will be at 2.5%, which just means that the emerging market rates are going to be substantially higher from that, which is why we continue to kind of link the two when we're looking at some of these pressure points. Now, interest paid, I think this is just something that is important to appreciate when you look at the actual paid in March, and then when you look at as treasuries continue to multiply, because we're continuously borrowing to finance ourselves, plus not only are we borrowing to finance ourselves, we're also having to roll that debt. And this is just showing the amount of interest that is going to have to be paid as these rates continue to go up. Then when you start looking at the growth tax, which is obviously when you think about inflation. So when you start looking at the combination of dollar price, oil prices, interest rates, that's when you start looking out and you see that pressure on manufacturing, why we think that we're heading not so much, again, that global slowdown as the U.S. continues. And this is looking at those leading indicators really showing us where we're going to end up. Now, when you take that and you look at, well, the consumer is the biggest driver, well, most of the spending is over because you've gotten free money from Uncle Sam. A lot of that has been spent, and anything that is left in 2022 has already been disseminated and has been spent, which again continues to be some of these pressure points that remain, leading to, again, these declines that we continue to highlight and talk about, which is why when you start looking at how people are spending, yes, they have more cash, but they've already used that cash, which is why the credit card spending continues to increase. Because you had a situation where everyone was now flush with cash. They took that, they paid down their credit cards. Now, as their wages have failed to keep up with inflation, people are turning back to using credit, which is why we've seen a big surge in credit usage, and that we don't see this stopping. Because when you look at 2019 and where we are today, as we had in last week's episode, you saw that there's still some room to have that credit expansion, and just based on the rate of change, we're going to hit that number very quickly, as we had a record new use of credit last week, and we think that's going to continue. And all the while, retail sales control group continued, weakened a bit, flatline. Retail sales non-store came down, and this is again pointing to Amazon, pointing to people just at home, just shopping. You're seeing that decline. You're seeing those headwinds because people don't have that cash, which is why we're seeing some of these slowdowns. But when you look at household cash exceeds debt for the first time in 3 decades. It's a weighting average, and that's why we're showing this, because it's going to be talked about. I'm sure you've seen it on the news, you've seen it on Twitter. If you remember what we talked about last week, all of this, a huge percentage of this, and by huge I mean over 80%, is weighted to the top 10% of Americans. So cash is above, but again, it's where does the cash sit? It is not evenly distributed across every American. It is not evenly distributed across even income levels. It is grossly overweight in the top 10%, with 53% in the top 1%. So again, that's why when you look at this, it's yes, there is cash out there, but it's not at the right place, which is why we continue to see some of these pressure points. Then when you look at the Empire State, the improvement in Empire manufacturing, estimate was for 1, came in at 24.6. New orders and shipments bounced from a contractionary expansion to expansion this past week. Work week expanded, but employment dipped down to the lowest since late 2020. 6-month expectations is lowest since the pandemic began. So you had some near-term pops, you had some near-term relief, but the look forward continues to be a bit soft. All the while, manufacturing prices paid hit a new record. Unfilled orders still elevated, but prices paid, again, leading indicator for inflation, there's still way more pressure to continue. New orders had a nice bounce after being negative. Manufacturing shipments also went up. We do expect that to soften, still be in growth. But again, as we said the last time, the new orders, we expected it to be slightly positive, but still closer. Clearly, we were wrong. We got a nice big surge. We do expect that to soften a bit. Because when you start looking at weekly earnings adjusted for inflation, breaking that trend line, coming further and further, not quite where we were pre-2019, pre-COVID, but moving in the wrong direction. And we expect this to continue to weaken as prices continue to go up, as we showed with prices paid, PPI, all of these leading indicators. And then when you start looking at expected new orders, firmly in the contractionary standpoint, expected business conditions expected to continue to get worse, which is why spending is going to ratchet down. People are going to try to protect themselves and make sure that they have enough cash to survive what they think is going to be some lean periods. All the while, capacity utilization surged to 78.3% in March, up from 77.7% in prior months, now at the strongest since January of 2019. And it's because you're getting, again, you had supply chains improve a bit. We have a chart on that in the next segment. And that was where providing some of that support for a bit more manufacturing activity. You still had some backlogs. Again, this is a net positive when you're looking at the GDP calculation. Consumers are coming under pressure, but this is that nice little bump to that investment, because you're starting to see production getting a bit better. And this should help those exports a bit as well. This is kind of that breakdown. Industrial production still firmly in expansionary territory at 0.9% in March. The level has surpassed prior peak in August of 2018. Again, there's that catch up. Supply chains improved a bit, so turning some of that into final product. But as inventories continue to build, that's where we think there's going to continue to be a bit of this overhang. So all the while, core PPI expectation was for 8.4%, came in at 9.2%. PPI year over year for food came in at 16.2%. These two pieces are key leading indicators that we've been talking about, and we don't see it stopping. All the while passing through, as we saw with prices paid in the Empire one, and that is not going to get any better anytime soon. And that's leading to, as we keep talking about, consumer price index. When we go back to the late 80s, you can see that we're right in line with where the median consumer price index was. 16% trimmed, new all-time high. I should say new highs since the mid 1980s. All of this is just showing that, again, showing from the leading indicators to where we currently are. Leading indicators are showing we're still not stopping, and that's where you can see that the pressure continues to be to the upside. And then the sticky price consumer price index continues to move higher. It's still not where it was in the 70s, but that's where we think that there's going to be a bit more of that makeup. Flexible inflation still remains high. We talked about gasoline and diesel in the EIA show. That's going to continue to be some of these driving points here, which is when you start looking at core services. So US CPI, core services, 4.7%. Food at home, 10%. Again, these are key things. Core, you have to eat. Eating at home is the cheapest thing to do, and it's still at 10%. Core services, 4.7%. Which is why you're seeing some of this sentiment get a bit worse. You did have a bounce. Gasoline prices did come down. Gasoline is typically kind of that leading indicator for consumer sentiment, but even that bounce is still well below where we were for COVID period. And consumer expectations still remains at near record lows, or at least still below where we were during COVID. Which is why when you start looking at the expected change in financial situation in a year has gotten better, but as things have gotten a bit worse, inflation continues to bite. We don't think it continues to improve, but kind of holds within and waffles back and forth between 100 and 110. Which is where you start looking at trade inventories. Again, these are the inventories we're talking about. U.S. manufacturing and trade inventories month over month was expected at 1.3, came in at 1.5%. Total business inventory to sales ratio, it's obviously improved, still at the levels that we saw in 2010 and 2005. So you're still seeing some of this movement, but inventories we see building, and we do see some of that slowdown in underlying spending. Which is then when you start looking at U.S. import index, not including petroleum year over year, Our import prices are at levels we haven't seen since 1987, and they continue to go up as we keep talking about international PPI. The U.S. importing this inflation, this is what we continue to see, and we don't see it stopping anytime soon, which is when we start turning to the next segment and where we see housing and some of the pressure points that remain on the consumer, and especially with focusing into and on the housing segment.